Hey, great to be back, despite Jim's comment of day drinking out here in Silicon Valley. Thank you.
He speaks the truth. Hey, I've seen at least one technician last week or so say the NDX's unwillingness or inability to buckle in a rising rate narrative has to be respected, and they took off their cautionary call. I wonder if that's how you see things developing right now.
So, Carl, I do think that we have to remember tech intrinsically is actually deflationary in its nature. You have this Moore's Law effect where cost structures often decline with scale and you get more impact and results from them. So when you look at software names in particular, you find that the compute and the infrastructure run these cloud providers are naturally riding this declining cost curve. You combine that with real estate rates and the lack of physical inputs that other supply chain issues are facing manufacturing industries right now that are driving costs up. And I absolutely would argue that software costs are somewhat immune from the inflationary dynamics. On the flip side, on the revenue side, you have high vendor lock-in and pricing power, which suggests that you can run pricing up in a forward inflationary environment if you choose to, which would actually be net margin expansive. And I believe that the reaction and potentially the overreaction to pulling out of subscription and tech names in a potential inflationary environment is actually misplaced for those reasons.
I think that last point's the more interesting one. You sound, well, two things. You sound a lot like Nadella and Cathie Wood arguing that cloud is a disinflationary tool that corporates will look to as they try to protect margins. But also this corporate CapEx boom and the money you're saving on things like real estate as we reinvent remote work is going to drive that top line.
Very much so. As organizations are looking for efficiency, software becomes that unlock, and increasingly the method of delivery for software is cloud-based. And so as people are wrestling with this fear of high multiples versus the greed of not wanting to miss out on this epic market run and however many months, quarters, or years we have left, I think you can find a safe haven in the high-quality names that are existing at hypergrowth levels that give you the buffer to absorb some multiple compression, and still in a reasonably sane band for multiples overall. So you look at it with this revenue growth adjusted multiple lens.
Byron, give us some detail on what quality means in software today. I hear what you're saying about this software being inherently deflationary, where you're coming up against inflation, but certain strategies have got to be better than others. So what are the key strategic assets that a software needs to have, whether it's industry focused, whether it's certain unique value that it provides to a market, say SMB? What do you look for to determine whether that company is less likely to be affected by this inflationary environment?
Right. So the high-level drivers of massive total addressable market combined with execution excellence certainly are front and center in our mind. Where that often manifests itself will be top-level application names where they've got some vertical protection, so they're insulated from direct competitors in many ways, and yet they have multiple acts where they can layer in payment streams. So I'd look at a name like Toast, which is growing at over 100%. It's in the Bessemer portfolio and family, and yet trading in high teens revenue multiples right now. You could also look at a number of the infrastructure names that have become the foundation of this reopening and infrastructure trade. And I look at a company like a Twilio, an Okta, or a Datadog in that bucket, where you, again, have these extremely high growth rates that are coupled with healthy multiples, but Twilio sitting in the teens and Okta trading at about 32 times right now, Datadog trading admittedly at a high level in the 50s, and yet when they're growing at 60, 70, 80%, you can see these massive markets where they've got growth endurance for many years ahead, and you can have a pullback in those multiples and still have stock appreciation in the coming years.